Hello everyone, this week we are going to talk about economic fluctuations, unemployment and inflation. First, let's talk about swings in the economic pendulum. You see a picture on the screen, and this is the growth of real GDP between 1960 and 2015. Although real GDP in the United States has grown at an average rate of approximately 3%, how do you understand that? Look at the red line. It's almost around 3%, right? The average rate. The growth has been characterized by economic ups and downs. And the shaded areas on this figure represents the recessions. And during the recessions, economic growth becomes negative. Look at, for instance, 2010. It was negative 4% real GDP growth. That means the economy is shrinking. Other than shaded areas, we see an increase in GDP, positive growth rates like 8% in 1965. So business cycles represent ups and downs in the economy. As you see, real GDP growth sometimes positive, increasing, sometimes negative. Therefore, these are the business cycles in the economy. And four phases are expansion. Expansion represents of the economy getting from the dip, and peak represents the highest point that you reach. Contraction represents from the peak point when the economic growth falls down, it represents contraction, and recessionary torrent represents the deepest or lowest point in the business cycle. In contrast with the business cycles represented here, real-world business cycles are characterized by expansions and contractions of varying durations and magnitude. So sometimes contraction may take 12 months or contraction may take 2-3 years. Or expansions could be 8-10 years, sometimes 2-3 years. Let's talk about economic fluctuations and the labor market. We have to first define some terminology here. The first one is employed. Employed is a person 16 years old or over who is working for pay at least 1 hour per week. So part-time workers are employed. Self-employed, that means if you have a small business, you are employed, or working 15 hours or more each week without pay in a family-operated enterprise. Unemployed, a person not currently employed, but that's not enough. Also, you need to actively seek for a job, or waiting to begin a job, or on layoff waiting to return to a previous job. Civilian labor force represents the civilians, but 16 years and older, who are either employed or unemployed. So when we say labor force, remember that it's the sum of employed and unemployed people. Not in the labor force, persons 16 years and older who are neither employed nor employed. So for example, retirees, students, homemakers, or disabled persons are all not in the labor force category. So the non-institutional civilian adult population is grouped into two broad categories. As I said before, the first one is the labor force. Here, labor force, employed plus unemployed. And when we want to know the percentage of labor force and among the total civilian population, we look at labor force participation rate. So labor force participation rate is equal to, in the numerator, you have number of people in the labor force divided by civilian population. So let's look at US population, employment and unemployment, February 2016. Civilian population is composed of everybody 16 and over, so the children are not included. That is 252.6 million. And we divide into two categories. The first one is not in the labor force, which is 93.7 million. And that includes household workers, students, retirees, and disabled people. And the next category is civilian labor force. It's total 158.9 million. And civilian labor force divided into two. Employed, that means employees, and self-employed workers. The total amount 151.1 million. And unemployed, 7.8 million. New entrants, re-entrants, lost last job, quit last job, and laid off. So if we want to find out some statistics, percentages, then we are going to calculate employment and unemployment statistics, starting with labor force participation rate. Remember, labor force participation rate has labor force in the numerator and civilian population in the denominator. So 158.9 divided by 252.6, 62.9%. We can find employment to population ratio. This time you use in the numerator number of employed people, in the denominator civilian population. 151.1 divided by 252.6, 59.8%. Rate of unemployment, which is, we call it U rate. In the numerator, you have number of unemployed people. In the denominator, you be careful here, it's the labor force, not the adult population. So it's 7.8 divided by 158.9, which is equal to 4.9%. So let's look at labor force participation rate between men and women over the years. We see a trend here. The labor force participation rate of men goes down over the years, right? It was 86.6%, now 69.1%. There are several reasons for that. First of all, now men spend more time in education, right? When you are education, you are not considered part of the labor force. And also retirement takes longer years. The time that they spend retirement increases. And another reason could be stay-at-home dads. They take care of the kid and stay at home, so they are out of labor force. And when you look at the woman participation rate, we see an increasing trend, right? Increasing trend, but slightly decreases in 2015. And the reasons could be also clear. One of the reasons is the technology. Household chores are much easier compared to 1940s. Plus, the role of the woman in the society has changed over the years. Women participate in the workforce more often compared to past. Let's look at labor force participation rate and employment population ratio between 1980 and 2016. Both the labor force participation rate and unemployment population ratio trended upward from 1980 to 2000, but then we see a declining trend here. See? Both figures fell sharply during the 2008-2009 recession. Each has had a weak rebound during the recovery phase of this business cycle. In 2016, both were still below their 2007 levels. Composition of the unemployed by reason in 2016. There are various reasons why persons were unemployed in February of 2016. 2/5, which is 37.2% of the unemployed, were dismissed from their previous job. More than 2/5, which is 42.3% of the unemployed, were either new entrants or re-entrants, some of these two. As you see, teenage unemployment for both men and women is high. The reason is obvious because teenagers are usually at school and they work part-time. Also, they don't have enough experience to work for. They don't have the skills, education. Therefore, their unemployment rate is high. Also, 20 to 24 for men and women is high, 9.3 versus 7.9. Once you get more experience, the unemployment rate for those 25 plus years old are lower. So we have three types of unemployment. The first one is frictional, and frictional unemployment is caused by imperfect information. That happens because employers are not aware of all available workers and their qualifications, and available workers are not fully aware of all jobs being offered by employers. So you can think about frictional unemployment as more of a voluntary unemployment. It is possible that you might have a job offer, let's say a job offer to be an officer in a business, but you want to work as an accountant. Therefore, you wait for the job that fits to your skills. Therefore, frictional unemployment may result. And another reason could be, for instance, you get a job offer from Tennessee or Missouri, but you want to stay in Dallas-Fort Worth area. So you might need to wait longer to find a job in Dallas-Fort Worth area. So frictional unemployment, as you see, is kind of voluntary in that perspective. Structural unemployment reflects an imperfect match of employee skills to skill requirements of the available jobs. So this happens because of the economy is being dynamic. There are sectors that are losing jobs, but there are new sectors that actually have more jobs. But then employees need to catch up with the skills of the new sectors. The reason is because they might be a good fit for the previous sectors that are declining, but not good fit for the new sectors. So that means there are not enough jobs for everybody. For that reason, we have structural unemployment. Structural unemployment reflects structural and demographic characteristics of the labor market. And finally, cyclical unemployment, this is a short-run unemployment, reflects business cycles conditions. So when there is a recession, for instance, unemployment rate jumps to 10%. But usually on a good time, if unemployment rate is 5%, then this difference, 5%, is the cyclical. So when there is a general downturn in business activity, cyclical unemployment increases. Employment fluctuations and the historical record. Now let's look at this picture. The unemployment rate from 1960 to 2016 illustrated. The blue line is the actual rate. As expected, unemployment rate rose rapidly during each of the 8 recessions. Here there is one recession, unemployment jumps, here recession, here another recession, here another recession, and unemployment jumps. In contrast, after each recession ended, the unemployment rate began to decline soon after the economy moved into an expansionary phase of the business cycle. Natural rate of unemployment is the friction unemployment plus structure. This is the unemployment that the economy experiences in the long run, and it's inevitable. It's inevitable in a way that you can't have everybody have a job at any point in a time. So that means, for instance, October, there will be people looking for a job. Maybe they want to change their job, or they want to find a better fit for their skills, or graduate students looking for job. Or some sectors are losing jobs. Some people lose their job and find job in another sector. And that is represented in the natural rate of unemployment. That's why it's more smooth. It's not changing that much. There is always some unemployment, and it's usually between 4 to 6% for the US economy. And cyclical unemployment represents these deviations from the natural rate. You see, this is cyclical. This difference is cyclical. This difference is cyclical. This difference is cyclical. It doesn't have to be always positive. It can be negative too, because sometimes actual unemployment rate is below the natural rate. So what is full employment? Full employment is the level of employment resulting when the rate of unemployment is normal. That means it's at natural rate, considering both frictional and structural factors. So when we say full employment, we don't mean that everybody has a job. That means that there is some unemployment. The unemployment rate is at natural rate, which is the frictional plus structural. Natural rate of unemployment is the level of unemployment that reflects job shopping. Some people are job shopping in an economy of imperfect information and dynamic change. So the natural rate of unemployment is neither a temporary high nor temporary low, a rate that is both achievable and sustainable, the level of unemployment accompanying an economy's maximum sustainable rate of output. Both demographic factors, we know that young workers as a share of the labor force have high unemployment rate, and the public policy, for instance, unemployment benefits. So people, when they get unemployment benefits, take their time to find a job, but that both of them adds to the natural rate of unemployment. Actual rate of unemployment generally rises above natural rate during a recession and falls below the natural rate during a boom. Now let's define actual and potential GDP, which are actually related to natural rate of unemployment as well. Potential output is the level of output when the economy is at natural rate of unemployment. So which is the maximum sustainable output level consistent with the economy's resource base given its institutional arrangement. So actual and potential output will be equal when the economy is at full employment level. Here is the illustration of potential and actual GDP. Actual GDP is the red one and the potential GDP is the blue one. As you see, during the recessions, actual GDP falls below the potential GDP. But there are also some periods that actual GDP is above the potential GDP, like here. 2008-2009 period, we have an actual GDP below the potential. The last topic we talk about today is the effects of inflation. Let's define inflation. Inflation is a change in the general level of prices as measured by a price index such as GDP deflator or consumer price index. Inflation is generally measured at an annual rate. When inflation is high, the year-to-year changes in the inflation rate are nearly always highly variable, making them difficult to predict. Let's look at the inflation rate between 1956-2015. If you take into account all years, then the average inflation rate is 1.6%. But when you look at specific periods, like for instance, between 1973 and 1981, the average inflation rate is 9.2%. And then 1983 to 1999, average inflation is 3.2%. And before that, 1956-1965, it's 1.6%. And the period of 2000 and 2015 represents a low inflation rate period, which is 2.2%. So there are two different kinds of inflation: unanticipated inflation and anticipated inflation. Unanticipated inflation is an increase in the price level that comes as a surprise, at least for most individuals. High and variable rates of inflation are harmful for several reasons, because unanticipated inflation alters the outcomes of long-term projects like the purchase of a machine or operation of a business. It will both increase the risks and retard the level of investment. So that's the reason we don't like unanticipated inflation. And when there is uncertainty in the economy, most of the investment projects are not going to happen. Inflation distorts the information delivered by prices. So inflation creates a confusion. Some prices rise more, some prices rise less, and then relative prices are not clear. People will respond to high and variable rates of inflation by spending less time producing and more time trying to protect their wealth and income from the uncertainty created by inflation. This actually can be explained very well after the COVID-19 period. Now we have an inflation around 8%, and now people are trying to find ways to protect their wealth, savings, not to lose value because of this high inflation. So if you look at the stock market or the bonds market, the returns are not as much as inflation, and therefore the money is losing value when there's inflation. Except the house prices. House prices jumped a lot, but other than that, people are trying to find ways to protect their savings against inflation. Nearly all economists believe that rapid expansion in the money supply is the primary cause of inflation. So when you have more money chasing for the limited amount of goods in the economy supplied, then there is going to be an inflation. So this is the end of chapter 8. Thank you.